All right, looks like we're live. Good morning, everyone. Thank you for joining us this morning. This is our third installment of our quarterly market update. You're seeing some different faces this morning. We had what they call game time decision. I think this is what feels like to me. We're saving some brain power, maybe just like the baseball teams do with their pitchers in October to make that playoff push. I guess we're expecting a big end of year activity. So
you're calling us the B team, huh, Neal?
No, yeah, we're getting. No, we just have the bigger brains. We have this, the veteran arms, right?
Okay.
That we can, we can get us through the end here.
Understood.
And of course, that time of year too, minor cold symptoms, all that stuff. So we wish our colleagues a full and speedy recovery. But what you got today, tenured crew to bring you the latest in market updates and headlines. Joining me, Mr. Matt Hobson, principal and co-founder of Energy Edge, and Mr. Andy Kyle, managing director of strategy and advisory services. And I am Neal Hendrix. I'll be your moderator for today's webinar. So, gentlemen, thanks for coming off the bench and joining us for today's start.
Hey, Neal, speaking of baseball, I did put on my orange and navy blue shirt for you. Since we now have one baseball team in Texas that's going to be playing into the fall. So
really would like to get through one thing without mentioning, but I will say that as of right now, your Texas Rangers are still the defending World Series champions for at least a few more days. So
well earned.
Yeah. All right, couple reminders, just some housekeeping. We want this session to be interactive. So we have enabled the Q&A feature at the top of the screen. I think you click on that and you're able to type in your questions, and we will work to respond during today's discussion. Also, this session is being recorded, and we will provide a link to that recording as well as the session's materials following the end of the seminar. So I think with all that, let's get to the topics. So gentlemen, with the end of September quickly approaching, we feels like we're in a transition period this time of year. Summer is somewhat coming to a close. School is back in session. We're seeing the seasonal shift in the weather. Leaves are changing. Pumpkin spice is back on the shelves and in everything, I think. So consider this a period of transition. Certainly the same is true. I think my favorite season, sports ball season is what I'll call it. You got the baseball playoffs around the corner. NFL started, hockey, basketball coming on as well. And then, our favorite topic around the office, I think, college football. And that the season for college football this year is a little bit different. We've got a different playoff structure. Certainly there's been quite a bit of realignment amongst the conferences. And it's created what, in my mind, this sort of anticipation, of what's to come. And certainly, I think that's a very similar feeling in the energy space. The markets are following, a similar pattern of transition and anticipation of what will happen in the future. So for today's agenda, we'll follow that theme. Certainly, the phrase energy transition's been around for a number of years, but it feels like not only are we in the middle of that transition, but we're also seeing some micro shifts within that as well. So as we cover today's topics, we'll highlight where those are. And of course, nothing could be more transitional than an election year. So we'll start with a preview of how we think some of the impacts to policy could happen following that election. Certainly things will be different in one way or the other. We'll follow that with a preview or a view of the natural gas market outlook and certainly what the latest is in that arena. And then follow that with market updates on all the major U.S. markets, ERCOT, PJM, MISO, and California. And then do a deep dive of our summer in review. How did the summer perform? What did the markets look like? And, what did we learn out of that? So, Matt, since I don't much like talking politics, I'm going to let you handle the preview of the election. and maybe some of the potential impacts to policy.
Yeah, you talk about redrawing the college football map and maybe redrawing an election map too, right?
Yeah, for sure.
It'd be interesting. Yeah, so for those that might recall from a previous webinar or from conversations that we've had one-on-one over the last year or so, we have been doing a lot more work with a quantitative analytics platform called Sequant. So this machine learning advanced artificial intelligence platform we've been using to do a variety of things like predict future energy prices, set hedge targets, take a view of where we think LMP or spot price settlements will occur in the future. We decided to do a little experiment and take that quantitative analytics platform, provide it with a lot of data around polling, and try to make some predictions or create some scenarios, 150 of them, in fact, of potential outcomes for the elections in November. And really focused on the US presidential race, whether that goes the Democratic side or the Republican side, control of the US Senate, same there, Democrat or Republican, and control of the US House. So all that we could really take away from all of these simulations, which we didn't really actually do because this platform can't handle that, but that there's a lot of potential for energy policy chaos. A lot of things that have been set in motion over the last sets of years, depending on what direction the election goes and sort of which party is setting the policy agenda, we could see a great deal of change really pretty early on within the new administration, within the new sessions of Congress. So a couple areas that we'll highlight here, and we spoke about this area a little bit on the last webinar, the EPA's power plant greenhouse gas emission rules. This has been very controversial. It's received a lot of pushback from the power industry and for that matter, from regulators at sort of the state and regional level who are very concerned about reliability and resource adequacy. So a couple of things there that could change, if the Republicans are more in control of the policy agenda, the requirements for carbon capture and sequestration for natural gas power plants in the future, those could be either eliminated or dates could be pushed back. There's a lot of concern within the industry about that really being a very limiting factor to getting new generation to the power grid. Another area would be around, some of the requirements that have gone into place for coal plants in the future, requiring co-firing and things of that nature. All of that could sort of be, pushed out in a Republican dominated administration. Something definitely to watch. And there's already legal challenges that are happening there. From an oil and gas exploration, production, and export, sort of the whole oil and gas value chain, from a production perspective, the Democratic administration has generally been focused on trying to limit, leases on federal land, offshore leases, things of that nature for drilling. In a Republican administration, you might see some of that sort of roll back, right? You might see an expansion of those kinds of leases. Another one that's been a hot button issue, Vice President Harris in the past has proposed a ban on fracking or pretty severe limitations on fracking. Hasn't been as much in play in discussions this year, but certainly something to watch as it would be obviously hugely impactful. Pipelines have been a major issue in the last sets of years, especially in terms of getting new pipelines built to bring natural gas, refined products, crude oil, a variety of different fossil fuel products from their source ultimately to markets. We've seen the Democratic administration generally focus on trying to limit those, and their focus being really around fossil fuel carbon emissions and trying to cut back on that through policy. Whereas generally Republicans have been more in favor of trying to bring those projects to fruition, really to lead to more economic activity and try to again kind of provide that reliability of the overall energy system. From an LNG perspective, this is another one that's had a lot of activity in the last sets of years. We talked about on the last webinar the Biden administration's moratorium on new export permits until the DOE completes a public interest analysis. That moratorium could be extended possibly under a Democratic administration. Under a Republican administration, that would likely be one that would be either lifted or sort of moved to conclusion relatively quickly. And I'll say that one is a little bit of a tricky issue just from the standpoint of there are those that would sort of be more in the Republican camp that would say we'd really like to slow down exports of natural gas just from a energy security and economic perspective. So maybe not as cut and dry as some of the other issues. Trade policy has been another big one, specifically with respect to some of the components that go into renewable generation facilities, solar panels, batteries, steel. Interestingly, it's been more the Republican side. The Trump administration put a lot of tariffs in place on those pieces. Some of those policies are coming to either their end or coming up for reconsideration. So it'll be a pivotal place to watch, whereas the Democrats have tried to sort of walk a fine line of, making sure that trade policy is, robust, and countries that are potentially doing things that are harmful to domestic producers, that try to put tariffs in place on that while not sort of slowing down the energy transition, which obviously is high on the list of Democratic priorities. And then lastly, from a clean energy initiatives perspective, tax credits within the IRA, particularly for CCS and hydrogen, other clean fuels. Some talk that those could be curbed. Not a lot of discussion that those would be eliminated, but more in terms of sort of how the Treasury guidance lines out how those credits can be claimed, could be a bit more restrictive under a Republican administration, whereas under a Democratic administration, you might see those be a little bit looser. One in particular that we've been watching pretty closely is some of the requirements for in-market time-matched renewable power. That's been a pretty limiting factor for some of these projects, and potentially that could be removed or at least softened under a Democratic administration. So overall, a lot of potential for chaos for sure.
Yeah, and it almost feels like, at least in some of my conversations recently, some of these things are sort of sitting on some of the things that would be influenced by these things are sitting on the sidelines, sort of waiting to see what November brings. So
no question.
Interesting to continue to watch.
It's sort of like Notre Dame in conference realignment, right? You're just going to sit on the sidelines and see what happens. Not really. I mean, Notre Dame's, they're too good for a conference. I shouldn't say that.
Oh, right. Wow. By the way, on that note,
I'm an Aggie, so I'm still kind of reeling from getting beaten by Notre Dame.
The beginning of the season for sure.
Exactly.
And remind me when we talk offline, see if that quantitative analysis can help with my bowl picks for this year. Maybe be more successful. So
that's a good idea.
Just a footnote. Yeah. All right. Moving forward to our next item, natural gas. Feels like natural gas had the spotlight, certainly in the last couple of years. The price charts were, designed more to look like extreme roller coaster thrill rides. As of late, it feels more like a kiddie ride to me. And Andy, with your perspective, hoping you can share kind of what your thoughts are, certainly how it affects consumers, and then certainly some of the big market fundamentals.
Yeah, certainly. It looks a lot like, not to offend anybody, but Michigan week 1 moving into week 2 of the rankings, as well as maybe Oklahoma this last week and a couple other teams that had high hopes and just aren't able to get to where they really
self-inflicted wounds there, Andy.
Yeah, I know. I'll take one on the chin there for myself. It was a tougher game than I would have liked to see, but
Absolutely.
Welcome to the SEC.
I'll sleep on Tennessee. That's right.
That's right. Well, yeah. So switching actually to natural gas. If anybody's watched anything in the spot market or in the dailies for natural gas, I mean, I think we did reach above 265, 264 yesterday, but really we've been bouncing around sub 250 for a while on the spot market, going back till pre-springtime even, with a lot of supply coming in still, mild summer. Prices on the forward have also declined as well, following kind of that more near-term spot price decline. We're additionally seeing, pipeline expansion finally coming to help, unlock some of the extra gas production sitting in the Marcellus. And while we're going to continue to see, volatility with prices kind of moving around a little bit here and there, we're well below where we were, and if you see on the chart, March of 23, but if you go back even another 6 months back from that those were all sitting closer to like $5 than $4. And so, all in all, I think these prices are, still very attractive, the mid 3 range. Given the election coming, those could change drastically. So if there's open positions that you have around gas, I mean, I think there's still a lot of attractiveness to put in place right now, and should be looking to get those closed up in areas where you have concerns around your price certainty.
Yeah. Yeah. And supply demand continues to be a big factor, certainly as we transition from summer power burn to winter seasonal. All eyes will be on natural gas supply.
That's right. We've had a really strong, consistent supply throughout the year. A few cutbacks, coming out of the last winter, but for the most part, we've been over 100 BCF a day, throughout the summer, and it can continue to expect to see that, throughout the rest of the year and into next year. If you look in the chart at the bottom there, the 2025 forecast is actually got us up into the 105, BCF a day range for daily natural gas production, which would definitely be an all-time high if we were able to hit that, for the whole year. 24 is taking a little bit of a step back from 23. Sorry, my phone's ringing. But yeah, so we're still really good on the production side. Looking at the demand side, we saw quite a bit of increased gas demand early in the summer, April, kind of May, June period, but that's kind of leveled off quite a bit in the last July, August period. And as well as, we're really trying to see that increased demand. If you look at, we'll get talking to this specifically a little more about power, but we're really seeing a lot of expectations for increased power demand across, the major ISOs, CAISO, ERCOT, PJM especially, and what that impact's going to have on the natural gas demand looking out past, 24, probably 25, 26, 27. That could change that chart we just looked at on the previous slide pretty quickly. But all in all, natural gas is in a great spot. Given where we thought LNG export was going to be and where LNG export prices were, this is a lot better place than what we thought natural gas prices were going to look like.
Yeah, and more commentary on that storage aspect too.
Yes. Storage has been great. I mean, we were above the 5-year average envelope for the better part of the spring and even into late June. We're currently, the very high end of the 5-year average with just under or just over 3,400 BCF in storage at this point in time. Overall, across, geographically, most of our capacity is being utilized pretty equally across the U.S., with the Pacific region actually probably at the highest level it's been in a number of years as they've opened up more capacity at Aliso Canyon. We did see some lower injections August, September period thus far across some of the regions, but a lot of them were already at higher capacity than normal. So it's been able to kind of level out. But all in all, storage is in good shape going into winter. And so winter seasonal weather will be the determining factor on kind of what we look like coming out of next winter. But right now in good shape going into winter.
Yeah, for sure. And I'm sorry, Matt.
No, I was going to say it's a big turnaround in the Pacific. I mean, a year ago with the issues with the El Paso Permian line, that metric was down at the bottom of that end of the spectrum and now much closer to the top. So big improvement.
That's right. And we don't have the basis in here between like Henry Hub to, to city gates out in California, either PGE or SDG&E, but those have closed quite a bit. They're now under $1 differential to Henry Hub, which is very attractive relative to historical price points. So,
yeah, for sure. Okay, and then there seems to be some activity in the LNG space.
Yeah, this is an interesting one. So Shell and BP have offtake from this Venture Global Calcasieu Pass project. This project actually started exporting back in early 2022, but is yet to actually fill the contract obligations it has with Shell, BP, and these other offtakers. And the reason for that is if you look at the chart in the upper right corner, you can see the prices that in that reddish orange color that the Calcasieu Pass project has been able to receive by selling outside of contract, just on the spot LNG market, versus what the majority of the LNG terminals have been able to receive on a long-term LNG export contract. That's a significant gain. If you look at that bottom bullet point down there, they expect that they've probably brought in about 3.5 billion in profits by not supporting the contracts that they've already entered into. So a couple of the big takeaways here are, if you look at the prices at the bottom of that chart on the right, you can see those are, $5-6 currently. That is one reason why we're seeing our local domestic NG prices stay a little lower. we're not having that massive basis anymore, and some of the LNG export terminal build out has been slowed by the Biden administration as well by putting a pause on that, which is helps keep interestingly enough, it's actually kept prices down because other LNG terminals from other parts of the world outside of the U.S. have actually stepped in and kind of filled that gap and lowered LNG prices. The other big takeaway is really the contract concerns here, and not so much that you guys are going to go enter into LNG export contracts, but on even your retail agreements, or if you're looking at long-term offtake from asset-specific PPAs or other types of contracts, making sure that language is crafted such that there is teeth in there when the project meets its ability to have NTP and then able to come online at COD, that it is obligating itself to the contractual obligations of the agreement put in place, and not having an ability to basically operate for 2 years roughly outside of the contractual obligations. So it's a big one. It's not necessarily specific to LNG, but it kind of allowed us to highlight a couple different things in one slide here. But we do think LNG is going to continue to expand, but on the retail and PPA side, definitely worth getting your contracts tightened up.
Yeah, a lot of eyes on this in certainly the oil and gas space, but in the power space as well, as you said. I mean, these big projects and long-term offtake agreements, precedent that this could set around, what is a reasonable time frame for commissioning prior to COD, and how loose the contract language is on that, and can it be abused and things like that. There's going to be a lot of precedent set out of this for sure.
Yeah. Good information to share. I think too, the precedent as far as the global price of LNG, right? Like what could that impact to the price of gas overseas, and how that could impact domestic pricing long term.
Yeah, I mean, it used to be that crude was the the global commodity. I think natural gas is quickly stepping into that place, or at least finding its own place within that standard. So,
certainly.
Yeah. So switching over to weather, this is for Q4 of 2024. You can see in the seasonal temperature outlook at the left there, above average for the entire Southwest and ERCOT regions, going all the way up into most of PJM and the majority of California. Looks like MISO will be kind of split right along the north-south line between equal chances and warmer on the southern part of MISO. While SPP will be mostly above normal as well. Looking over at the precipitation, about what you would expect. When it's going to be above normal, you're going to have lower precipitation than normal as well. So those kind of line up pretty well across, ERCOT, most of SPP, Southwest, and then the southern part of California, while the far northeast is going to have potential for, and far northwest, above average precipitation. Be interesting to see what happens with Hurricane Helene. I sit in Florida. My kids are out of school tomorrow. It's not going to get anywhere near us. So yeah, we'll keep an eye on that one as well. But nothing that's going to be long term, I think, coming out of that in our world. So unless it keeps going west and goes into Louisiana more, it could be more concerning.
More impactful, certainly. And this is the shoulder season, Q4. I think really the anticipation for what the winter forecast might be like, when those might arrive. Remember that we're coming off 2 pretty mild winters. That's lending to that gas storage capacity being elevated. So I think folks are eager to find out, if winter's going to arrive, and certainly when. And the impacts too.
Yeah, Jan Feb forecast should be out soon, and we'll be able to get those into our normal monthly market updates.
Yeah, absolutely. All right, so moving forward to electricity markets, a lot to cover here. Certainly, taking a view on how each of these are currently performing and some of the fundamentals. Andy, I think you wanted to cover ERCOT, have a view of how things are shaping up so far in Texas.
Yes. Well, from a CalStrip prices, looks like my Oklahoma team, on the bottom there, it's just kind of trending down a little bit, unfortunately.
The hype train.
Yeah. Hey, Oklahoma's a Southeast team now. You can't talk about that in an ERCOT context, right?
That's right.
I mean, they were never
I mean,
technically ERCOT, but I'm just
fair,
using him
fair.
as a graphical explanation there. Sorry
Yeah.
about
There you
that.
go. There you go.
But, overall in Texas, we had a fairly, mild summer, with very strong solar production. Solar is now knocked Nuke off the stack as the number 4, generation capacity or supply, I guess, which is interesting considering that we've got quite a bit of nuclear sitting in ERCOT. And then looking at the LMPs, you can see down there, we had a significantly different LMP output this year. I think on average we're somewhere around like $30 year to date for LMP across ERCOT versus I think last year was closer to around like, I don't know, 65 or something. I can't remember off the top of my head. Wind generation continued to expand, year over year on the chart on the right, along with solar. Coal going in the other direction, and natural gas continuing to be the lion's share and the main driver of generation, in a heavy industrial growing demand state. Um, you know, the one thing that was significantly changed from 23 into 24 was really how ERCOT treated ECRS and the implication of kind of the PCM coming forward. And so that's something that we're still digging into, and how those changes really, impacted the outcome in 24 versus 23. But I do think it's a pretty big driver in the fact that they didn't put as much reserve capacity into ECRS or even some of the other ancillary services, and left a lot more generation available to actually meet supply as opposed to being held in reserves. And so that is something that we're going to try to do a deep dive on further, which hasn't been done yet since it's not through the end of September technically for the full summer.
Texas summer. Yeah, absolutely. And those being ancillaries to try to boost capacity as a means for the grid, without any major announcements for, new capacity, but that's changing certainly with the Texas Energy Fund. We've seen some movement there, and there's an update on where the PUC sits for that program.
That's correct. So this is the in ERCOT program. So 5.4 billion has been allocated, equating to about a little under 10 gigawatts of additional supply, all thermal capacity spread pretty attractively geographically across ERCOT. If you think about like the amount of expected load growth in the West, and having some significant assets out there, kind of in the L of the Panhandle, is attractive place. The other ones geographically are very well sited for the major load centers of Houston, Dallas, Austin, San Antonio, as well as some additional assets down near the southern Gulf Coast to support some of the industrial growth and demand down there. Overall, there were 72 different applications. They picked these 17. I will say that I think the PUC staff did a really good job of allocating assets to long-term owners of generation, load also, as well as differentiating it between regulated and deregulated entities in terms of who actually got assets into the final exception here. Of the projects, 11 are already in the queue, representing roughly 7,100 megawatts of the 9,800, and they come online at a variety of different times. Not much is really coming online until really summer of 2026 when we get a full gig online, and a lot of the other ones still are unknown. About half is still unknown in terms of the expected online date. But all in all, I think this is a pretty ambitious program, but also one that the state needs. If you look at the demand that's expected in ERCOT over the next 7 to 10 years, even if we get half of that, we're going to need this supply to meet the ongoing growth expectations. This summer being mild, if we were to have this summer, the same summer last year for 23, this summer, I think we would have done fine. But 2 more years from now, with the demand coming online, that would be a bigger challenge without thermal assets sitting in the stack.
Yeah, no question. Well, and to that end, I think we're hearing rumors that potentially the legislature in Texas might consider another, I think, $5 to $6 billion for this program that would add, potentially another 8 to 10 gigawatts of generation. So possibly more coming.
Yeah. The only problem I have with that is really the slippery slope around regulation of that. I'd almost like to see something that guarantees them a minimum, LMP price or something, as opposed to just giving them, really low cost capital. But I have my deregulation hat on, I guess. So
there you go. Deeper discussion for another day.
I have very strong opinions around the college football thing as well in terms of how we should go after that, but no one listens to me on that either.
Yeah.
Well, I can see a special webinar on like a Saturday morning, shaping up maybe in the future. I think it'd be the three of us and that'd be it, but that's okay.
We need regulation.
Like the Manning brothers, but we'd sprinkle in energy quips and quotes.
There we go. I don't know if we get a lot of takers for that, but we might have fun.
Our moms might enjoy it.
There you go.
All right. So talking about Texas, certainly the demand curve is the trajectory is high, bullish in that market. I would say the similar goes for PJM. Certainly a transition happening there. We saw quite a bit of movement this year, and I think the future is bullish as well. But Matt, you've got a perspective you want to share.
Yeah, and I think as with any transition, it oftentimes it's fits and starts. And I think coming into the summer and the spring, obviously there was a lot of discussion similar to ERCOT around load growth and the potential for some really dramatic increases in overall demand. What we saw in PJM, sort of similar to ERCOT, was a relatively normal summer from a weather perspective, and ultimately that sort of led to prices kind of fading as we move through the summer. And to be fair, I think the reality is that demand growth was probably not going to be a major 2024 event. It's more of a 25, 6, 7, certainly 8 and beyond. But even that said, and we have some analysis that we'll share towards the back of the discussion around, there were increases in load growth when you look at it more from sort of a weather normalized basis. But all of that said, as you can see from the LMP settlements, very low. September's trending to be close to one of the lowest months of the year. August was quite low. I think generally the forwards are sort of reflecting that reality that, hey, right now, what we see from day to day is not super tight grid conditions. Things are generally okay. I'll highlight too, from a solar perspective, we are starting to actually see some solar generation contributing to the fuel mix in that upper right graph. The interconnection queue issues are finally starting to resolve themselves. Again, albeit it's slow to kind of still work through that process, but some of those projects that have been in the queue for a long time are finally now coming to fruition and starting to generate power. So something to watch in the future. We expect to see more growth there for sure. But to give some further detail on those longer term load growth expectations, PJM puts out an annual load forecast. And so we wanted to share some insights from that in terms of what we're seeing there. And similar to other markets, still calling for some really unprecedented in terms of what we've seen historically, load growth in the next, sets of years. And interestingly, for a market in PJM, that's generally been a pretty stagnant market. I mean, really from, call it 2010, 2012, 2013 to where we sit today, peak demand has actually gone down a bit, when you kind of just look at it on a straight line basis. But what's changing all of that, as we've talked about in the past, is growth in data center demand, growth in, some sectors of industry demand, in places like the Marcellus, growth in oil and gas demand as well. So the graphics you see on the right reflect what PJM is projecting on a go-forward basis in terms of those peak demands. And you can see that the blue line represents their forecast from 2023. The green line is the forecast from 2024. So in just 1 year, not only did the overall level where they expect load growth to be by 2038 increase dramatically, but the trajectory of how quickly it gets there, certainly increased too. One of the things that's interesting about this load growth is we've talked about very concentrated in several of the utilities that are very data center heavy. AEP in Ohio, Dominion in Virginia, those are very big data center markets, and those utility territories are projecting some massive increases. I think both are projected to more than double by 2038, which you put that in context and you think about a utility footprint doubling in load. It's not just a generation story, it's an infrastructure story. How do you build out the transmission, the distribution systems, the substations, all of the things that you need to deliver that power if you can get the power to market, from a generation perspective. The growth is going to be quick. I mean, we're looking for meaningful increases in 25, 26, 27, 28. From a generation perspective, and this is, goes back to Andy's earlier comment about, how do you, from a policy perspective, incentivize the generation? PJM being a capacity market, when you contrast that with ERCOT, ERCOT's doing loans, they're doing low interest rate loans, some grants, things of that nature to try to get more generation to market. With PJM, these load forecasts drive the amount of capacity that the ISO seeks in their auctions. And so they have a very meaningful impact, as we have seen, and we'll talk about that in a second, in terms of what the price of capacity is within these markets. So a different approach in terms of policy and different market structures. So those capacity auctions, typically have been on a 3 to 4 year cycle, or on a cycle where you're seeing those auctions happen 3 to 4 years ahead of a given consumption period. We've gotten quite a bit behind because of some of the issues that were happening at FERC with regards to RPS policy, with regards to resource adequacy and some other things at PJM, to where we've really just gotten visibility within the last few months as to what capacity costs for 25, 26, the planning year 25, 26, which most of you probably know runs from June until May. So June of 25 to May of 26. Really shocking results. I think the market expectation was that capacity costs were going to move up as a result of some of this load growth, but I don't think anyone was expecting the magnitude of the increases that we've seen. And on top of that, I think expectations now are that we'll probably see even further increases for 26, 27, which we'll see the first auction results coming from that later on this year.
Yeah.
But to give a view,
I have two questions on that slide, if you don't mind, going back one. Why do we see the winter forecast increase faster than the summer forecast? Number one, and number two, do we really think that blue to green is realistic in that time frame? I mean, given the other constraints associated with getting load online.
Yeah, I think from a winter perspective, I would probably point to some of the things that we've seen in other markets, like, the predominance of electric heating, and electrification and things of that maybe sort of present themselves a little bit more in the winter from just a growth perspective. Okay. That would probably be the biggest thing that I would point to, with regards to just the sort of feasibility of all this. Yeah, I mean, I think that's an unknown, right? I mean, again, these utilities, they have such the process to be able to site new lines, to get new transmission lines approved, to source all of the equipment and the material, and to construct these things. It doesn't happen overnight. I mean, the process of just getting it all in place where you have the approvals that you need to go do it can take multiple years. So yeah. I think that is a real concern, and I think that's part of why, as a preview, some of the things like what Amazon did with the nuclear plant up in, I think it's Maryland, the recent announcement from Constellation of Microsoft, the deal to repower 3 Mile Island, those are examples of really large loads that recognize that A, it's going to be hard for them to get interconnected on the timeline that they want at a greenfield site, and B, having generation in essence of your own, whether it's ownership or via a contract, is valuable in those circumstances when you're talking about potentially a gigawatt of load. So yeah, I think there's recognition of that concern in the market for sure.
Makes sense. Thanks.
Yeah, so from a capacity perspective, this sort of tells the story. I mean, we're now going to see capacity prices in the 25-26 planning year that we haven't seen, well, in the history that you see here, going back to June of 21. And I think if we had more history on this graphic, it'd be several years back before you would see levels similar to these. And interestingly, most of the markets were pretty similar in terms of where those prices cleared, but we did have a few, for example, BGE in Maryland, Dominion in Virginia, not surprising, given the data center growth, that cleared quite a bit above. So again, expectations are that the next one, could be even higher potentially.
Well, Dominion's been self-supplying capacity, for a number of years, and they were a late entrant into the capacity market this year when they realized what their load growth expectations looked like, and I think they realized they were going to be short, so they stepped in and bought some. So yeah.
Yeah. Pretty interesting for sure.
Yeah, for sure. And we think those are coming out in December is the next auction?
I believe that's right.
26, 27? Okay. Yeah.
Yep.
So then moving into the MISO market, and I mean, you're getting some of that same demand growth, I think, obviously not as much. But Matt, tell us more about how this is shaping up.
Yeah, it's interesting. We talked about in a previous webinar here some of the concerns around capacity and resource adequacy and some of the same themes around load growth. I think it's been in this area, it's been a little bit more market specific. So there's been, challenges in Ameren, Missouri territory as an example where capacity prices have cleared drastically higher. But the rest of the MISO market has generally been pretty okay. From a power price perspective, though, just on the energy side, downward pressure here too. I mean, a similar pattern to what you've seen in ERCOT, you've seen in PJM. A lot of discussion about load growth, prices kind of trading up through the end of winter and into spring, early part of summer. Generally, kind of coming down as we didn't really have a crazy hot summer. We didn't materialize any of these really large load spikes that had everybody really concerned. But I think a common theme, and we've talked about this amongst ourselves, could this be sort of the calm before the storm? Is this really what we're seeing real, given the sense of, this load growth was not going to happen overnight. We kind of knew that. Now going forward, does that kind of lull people into a little bit of a sense of, okay, well, it's not going to be an issue. We don't think that's the case at all. I mean, we definitely see, we saw it from PJM's report, we saw it from ERCOT's projections. We think the load growth is still coming, and this may be sort of a window of opportunity to get some positions in place and sort of provide some protection and coverage for future years where we expect more volatility. But definitely, as you can see from the spot price settlements, not a lot of volatility here this summer. I mean, September, August, looking to be some of the lowest months of the year from a spot settlement.
Yeah. Okay. And then Andy, another view in California, it feels like this market definitely has transitioned from just this time last year, as far as the charts go.
Yeah, you can see on the CalStrip chart at the bottom. I mean, it looks very similar to what natural gas looks like. It's kind of a very linear downward trend, except that it's even sharper than natural gas. And the reason for that is the other attributes in California are substantial, RA and RPS specifically, as well as the decline in natural gas as a resource. If you look at the chart on the right, you can see solar is year to date very, very near to where natural gas is in terms of potentially taking over as the number one producer in the stack. And that's really part of the RPS requirements in California to get to the 60% renewable and then eventually the 100% emission free power supply in the state. Hydro continued to perform well this year as well, a little behind last year, but nothing to be concerned about. Wind has been a strong performer there, but not a big piece of the stack for a number of years. The big thing that I saw again was the imports are still they're fairly strong. We'll look at the summer here in a minute. You can see in certain hours the imports were big supply piece to kind of backfill for other assets maybe not showing up when they were supposed to be. I mentioned RA and RPS very very early on there. RPS is now somewhere in the $40 a megawatt hour range. When you start looking at what PCC ones are trading at $75, $80 and 25, 26, and you have to get a substantial percentage of your load supplied from that. I think it's like what 46% or something right now. I can't remember. It can add up very quickly. PCC twos, which are not generated in the state, but can be delivered into the state, are also in that $50 range. And then PCC ones are substantially lower, but still, that math adds up pretty quickly. So what it's done is it's put some downward pressure on the actual energy prices, along with less expensive natural gas. And then the other piece is the RA. So resource adequacy is changing dramatically in California. It's always been a monthly number where basically you had to have 15% more than your expected demand in a month backstopped with assets, with a capacity asset, and that's now moving to an hour by hour view, or what they're calling slice of day. And so basically, you have to have a capacity, asset pointed to for every hour of the day, to meet not only 100% of your expected supply, but 118% of your expected supply every hour of the day. So this is what the load serving entities, whether that's a CCA, a utility, or an ESP, are having to look at out there, and it's really driving prices up. I don't have any marks that are in the last 3 or 4 weeks, but last I saw, they were on par with where energy prices are in terms of that $60-$70 kind of per megawatt hour range, which can make it an all-in price somewhere in the $70 of energy, and you're coming out to $220 before you even get it delivered. It can be pretty substantial and pretty painful for large consumers out there. Hence why you're seeing some of the exodus coming out of California recently, in terms of the likes of Chevron and others. On an LMP basis, though, 2024 has been very low relative to the forwards. Somewhere in the sub $30 on average. I think it's closer to like low 20s. So it's interesting to see, as you put more and more renewables on the grid, you're shifting price away from energy and shifting it to other components that are, contributing to the revenue going to those assets. But it really changes the dynamic quite a bit. So,
yeah, certainly. Well, thanks for that. How about we get into, for each of those markets, do a little bit deeper dive and kind of compare the summer performance. I think we're going to take a look at ERCOT. And, I talk to folks and I tell them, oh, yeah, we had a mild summer. And they're like, no, we didn't. It was hot. I remember I didn't go outside. My air conditioner was running. I was like, well, relatively. Yeah.
Texas standards.
Sure. Texas standards. Yeah.
Yeah. I don't know what the actual temperature gradients were, but I don't think it was massively cooler. It just wasn't as consistently hot. You just didn't have every day at 4 o'clock wasn't 103 degrees and no wind. But so this is just kind of a comparison of 2 days that have very similar kind of load profiles, and not to give away the answer, but somewhat similar generation profiles. They're somewhat different because of the change from one year to the next. But the chart on the left is June 20th, 2023, and really shows significant reduction in wind as we move from really noon into 5 p.m. And what happens is there was some high outages that day, natural gas and coal, but we really saw prices spike up because there wasn't enough wind to backfill for the solar as it declined, moving past about 6 p.m. into 9 p.m., which ran LMPs up into, for 5 hours, more than $3,000 an hour, which averaged about $900+ bucks for the day. So pretty expensive. But then compare that to another, day in August this year, very similar in terms of the expected kind of demand hour by hour across the grid, but the mix of the generation that met that supply was substantially different. Less wind earlier in the day, significantly more solar, about the same amount, during the peak of the day from a nat gas, coal, and nuclear perspective, but the increase in the amount of wind or of solar that's now in ERCOT. We added about 8 gigawatts of solar between basically summer of 23 and summer of 24, which means at 5, 6, 7 o'clock at night, you're still getting a good chunk of output from those assets. And what that's doing is it's giving more flexibility in those later hours for the wind to have time to show up, or to not necessarily be as strong as it had to be in 2023. Additionally, you're having a lot more battery showing up. So roughly 3 gigawatts of battery showed up to help bridge that gap as well. And so, looking at the red dotted line there, you can see the prices in 2023 versus the almost, right on the zero. It's not zero, but the red line on the right is significantly lower. And so it's a combination of, the asset mix, and then maybe not being quite as hot and then some of the changes that ERCOT made with the ECRS and having more generation available for supply as opposed to reserved for ancillary services.
Yeah, for sure. And we see it more. Yeah, to your point, that renewable, that storage really made a difference.
That's correct.
This year.
So yeah, so then this is kind of the full summer is the wrong word because like I said, we're still in September, but this is basically going through like, I don't know, a couple of days ago, the 22nd, 21st, I can't remember what we stopped it on, but really looking at the deviation between 2023's summer generation mix load and then LMPs across each hour of the day. So it doesn't take into account whether it's June, July, August, or part of September. It's just looking at each hour across the entire summer to get an idea of what generation, was there, what generation wasn't there. And you can see solar all on the positive side. So anything on the positive side means that it was an increase from 23 to 24. Anything on the bottom means it was a decrease from 23 to 24. So, natural gas got knocked out quite a bit. Solar increased by 41% over the summer, providing additional 5,600 gigawatt hours. Whereas batteries, almost not quite double, but 160% increase in battery capacity during really the late afternoon hours, getting almost to 500 gigawatt hours of additional battery supply during those hours. While natural gas decreased by 6,000 gigawatt hours over the summer, it's a substantial reduction in natural gas. And why, when I talked to you guys earlier about ERCOT, I was saying that solar is getting closer and closer to kind of, natural gas. And even though natural gas for the year has actually produced more than it did same year to date for 2023. So, we're just talking about summer here though. And then coal continually getting knocked off the stack. That's something that we're seeing a lot of. But then even the wind showed up a little bit more, across that afternoon period, day in and day out, which created substantial differences in LMPs across that period. You can see, at that 8 p.m. hour, a $400 and roughly $20 difference between the daily average LMP in 23. The hourly average LMP in 23 and the hourly average LMP in 24 for that hour ending 8 p.m. Wow. So yeah, quite a bit of difference though. And then you talk about the mildness. The load actually was a little bit lower. None of this is weather normalized. This is just looking at load versus load. So did see a little bit of a decline overall in load of roughly about 2.5 gigs, 3 gigs maybe.
Yeah, and we did surpass the peak, right? We just barely eclipsed it from last year.
Yeah, about I think it's a couple hundred megawatts of increase. But yeah, looking at it peak on peak is more complicated. It's easier to kind of look at it from a total load perspective because you can really get the averages to work. We've looked at it on peak, and you're trying to find a day, versus another day is not as easy as you think. So.
Yeah. Well, and it's interesting you talk about the coal plants. Significant, obviously, drop in production coming from coal. And you think about the way those plants are designed to operate, they don't want to be running only overnight and then really ramping down during the day. So I think I won't sort of postulate on, the benefits of coal-fired generation, what have you, but more from just a resource adequacy perspective, from a reliability perspective, I would be concerned about, does this kind of a trend accelerate retirements of coal plants in Texas and in other markets for that matter too?
Yeah. So totally agree. Yeah. There wasn't any significant retirements in ERCOT for coal from last year to this year. There were some, but there wasn't anything that's like, oh, it was, multiple gigawatts. Really it was the expansion of wind, solar and battery that really kind of helped fill the stack. Yeah. I know we're kind of getting a little short here, so I'll speed up a little bit on
PJM. I think we're going to look at PJM and then California.
Yeah. So same look for PJM. I won't belabor all of the points on here, but as you can see, we talked about that load growth. This is non-weather normalized. So this is just, load growth across the hour, summer 23, summer 24. You can see, upwards of 9 gigawatts across the kind of the workday period. It's pretty big, especially considering there was a little bit more, I guess, heat up in PJM, but it wasn't like it was substantially different. Solar stepped in, providing about 40% of the additional supply requirements. Natural gas also up about 17%. Coal up, wind up, but really, the load was up, so therefore you needed more on there. Nuclear provided less, and I've got natural gas in there twice. My bad. So the interesting thing is not a lot of battery storage in PJM. Not a lot of wind doing much for us. There's a little bit of wind increase you can see across kind of that light green, but all in all, it was really solar and the traditional thermals stepping in, with solar being the lion's share during the middle of the day. This did actually increase LMPs a little bit, as just higher loads are going to put more strain on the supply, to meet those, or sorry, the generation to meet that supply. So that increased LMPs across kind of the on peak, while it reduced during the overnight for the most part. All in all, nothing real earth shattering here, other than we are starting to see that load increase potentially. So. And then
CAISO
CAISO,
California.
yeah. So CAISO, I'm not going to get on my election, commentary and where we are with imports from countries, but California is a big believer in imports. If you look at that gray line across the top of basically starting at like 8 a.m. through about 6 p.m., imports provided a substantial amount of the supply during the middle of the day, as did solar, a little bit of wind. The real story for the ramp out hours, as the solar starts to decline, was the battery storage starting to really show up. We saw an additional 2 gigawatts of battery storage on average across hours 6 p.m. to 12 midnight, with almost 4 in a couple of those hours. Natural gas continued to get knocked off the stack. Predominantly during the day, obviously, but even overnight, natural gas was down, as imports kind of overtook some of that generation potential. LMPs overall were down, pretty substantially, with the exception of hour ending 7. They were down a lot in the ramp out hours. Between like looking at 5 p.m. to 8 p.m. or so, on average around $20 lower, with the exception of that one hour of 7, which is interesting, which tells you that the solar is starting to really show up, and you're getting to a kind of a quantity of production there that it's really knocking a lot of the gas off the stack until later in the day, and the batteries are doing their jobs as well. So, it's doing what they expected to do, at least this year, when you had strong hydro and other supply to be able to knock natural gas off the grid or off the stack.
You don't want to think
Very
about
good.
droughts out there. Be challenging. Be challenging to navigate through a drought.
Yeah, certainly.
Yes, it would be. I think you'd see a lot different prices on the forwards right now if we had another dry summer.
Yeah. Absolutely. Well, that concludes our content. And before we kind of wrap up here, I do want to give shout out and much gratitude to what I would call the production team, since this is a lab event, to Glenn Cowan, Jen Adams, John Clark, for their contributions pulling this stuff together, the team behind the scenes. You guys do great work, and we really appreciate you. I don't see any questions, but I may not be looking at the right screen. But certainly if there's any follow-up, you can reach us. We're always happy to talk more about these concepts, and certainly provide perspective and expertise as it applies to your specific situation. And like I said, following this event, we will release the recording and these materials if you do have any follow-up. So any parting thoughts, fellas, on energy, college football, otherwise?
I think my Aggies have a game against Arkansas this weekend, so hopefully we get a good result.
Things are picking up in the conference play. Hope everyone stays safe that are in the areas with the hurricane. Certainly thinking about y'all.
Absolutely.
All right, appreciate it. Thanks, guys.
Thanks, everybody.
Thanks, everyone. Have a great week. Take care.